Hey, it's Eric, and in this video, I'm going to show you how you can trade options on VXX for consistent monthly income. And what we're going to take a look at is buying put spreads on this ETN and look at some of the backtest results of how this strategy has performed the last few years. We'll talk about that. Before we get started, though, I'm going to put some additional information in the description of this video. I'm going to put a link to the backtest software we're going to look at in a minute. Some people really find this useful. I know it's been very, very helpful for me. I also have another SPX weekly option strategy for those that want to trade a shorter time frame, so there'll be a link for that. And if you're interested in getting email trade alerts for all of my vertical spreads, there'll be a link for that information as well. Okay, so let's go ahead and take a look at the VXX. And you can see that I have the daily chart on here. And the first thing you'll probably notice is that the VXX basically just keeps going down. And that's really part of the reason why we're going to take this trade each month is because we know that there's a built-in downtrend with this particular ticker. And that has to do with the way that it's calculated. I'm not going to get all into the details about that because it's a little bit complicated and I'm probably screw up the explanation. But essentially, the VXX tracks some VIX futures, and it's got this rolling monthly sort of calculation, which inherently puts some pressure on it, and it tends to go down over time. Now, if you can see, just on this chart here, we can see we started at 170 and we're down to the 40s. And that's not actually correct because this thing will do reverse splits. This thing will get down into the teens, possibly the single digits, I'm not sure, and then it'll reverse split back up, and then they'll kind of adjust the prices. If we zoom out like to 3 years, this thing used to be $700. That was actually never the case, I don't think. It just continues to reverse split, but you can also see that it has mostly downtrends, and there are some uptrends, some short-term stuff. That's a weekly chart. But for the most part, we're going to look at bearish put spreads, and we're going to talk about the timing. So first of all, do you see the red lines on here? These red dotted lines are the monthly expiration. And the trick here is to trade them every month, I should say. However, to not trade 30 days. Now, a lot of times I put spreads on that are 30 days or less. With this particular strategy, it turned out to be a lot more profitable and consistent when you took a 60 or even greater, like a 90-day. We're going to look at a 60-day rollover. And what we're going to do is, we'll just pick sort of this particular time frame. So, in theory, each one of these rollovers is about a month. And in this particular month, we had, we started off down here and the VXX spiked. Well, had we bought the put spread 60 days out, we would have taken some heat, but ultimately 60 days later, or even 40, 50 days later, it is below, and our put spread would then be in the money. And when you buy a put spread, we're going to look at buying slightly out of the money put spreads, and they move in the money. That's how you profit from a put spread or a bear put spread, a debit spread. And so that's what we're going to look at here. So let's go ahead and dive into the backtest software, and we can see how this performed the last few years. So I'm using CML. Again, I'm going to put a link in here that's got a special promo price if you want to check that out. It is a paid service, but I think it's super awesome. But again, you're going to get a better deal if you use the link that I have for the promo. So what we're going to do is we're going to set this to days to expiration, and we're going to look at 60 days. And what we're going to simply do is put in the ticker VXX, and we're going to do a put spread, and we are going to buy a put spread. Now, I've already loaded up the deltas. I've already done some research on this. And when you would talk about puts, deltas, anything less than 50, which calls as well, are slightly out of the money. So the sweet spot that I've found, and I did a lot of backtests on this, and we're just looking at 2 years right now, the sweet spot is somewhere around buying a Delta 40 put and selling a Delta 20, or buying a Delta 35 and selling a Delta 15, which means that both of these options would be out of the money. And the interesting part here to me, and this is something you have to kind of consider, obviously in the money put spreads are going to have a higher win rate because they're in the money, and the probability says that if it's in the money, it's going to stay in the money. So a delta 70 put has a 70% chance of expiring in the money. And now that's on a typical stock, but since we know that VXX tends to continually push down, I'm actually comfortable buying out of the money options. That's actually one of the only times, this is probably one of the only times I really like to buy out of the money options, is when I know that there's a headwind against the stock and it's going to be going lower. And I, there might be a few other volatility type tickers that do that, but this one in particular I like. So again, we're going to look at buying a slightly out of the money put spread, and we can see that the win rate isn't that great, right? It's about 50%. But the difference between this win rate and that win rate is the actual size of the winners and the losers. And this is what this software can really help you with. So this seems good. Oh, it's a great win rate, 92% win rate, only one loss. Now, again, this is doing it every 60 days. So there's only, 12, 13 within 2 years. But if I click on this, you can see that the average winner was $43, and here the loss is kind of nil. Let's go to the next one just so we get some data here. So 10 wins, 3 losses. I mean, it had a decent gain. You would have doubled your money, 100% gain for the amount that you risked. If we come in here, the average win was $50 and the average loss was $49. So it's kind of an equal win the loss, and you have more winners than losers, therefore you make money. But the interesting thing down here is you actually see the total return becomes greater even though the win rate is less. And the reason why, if I click on the delta, we'll do the delta 40-20, the win is actually larger than the average loss. And that's actually, that's not something you see all the time with options. So not only do you have a slightly more winners, the win is much bigger than the loss, which is, something to be, something to consider. And that kind of continues out here. So let's take a look at I have a 35-15 and a 30-20. They're all around the same range. Here, the win is bigger than the loss. Right, here's this one. The win is bigger than the loss. And so, this is basically the strategy. 60 days to expiration, you're going to look at buying a slightly out of the money put spread. You can change the deltas around if you want, and we'll look at the option chain here in a second. But basically, you want to buy a put spread that's slightly out of the money. I shoot for somewhere between buying a delta 35-40 and selling a 15-20. So let's go back to Thinkorswim and look at the option chain. So you can see here that, we're going to look at October. I'm already in this trade. This has 50 days left. Normally we would want to do 60 days. But if I scroll down here, this column is the delta. So the position I'm in, I think I got the 45. So you can see this is a delta 40, so it's slightly out of the money. And I bought a delta, I think it was a 25. So I bought the 40, I'm sorry, it's a 30. So I bought the 45 and sold the 42. So it's a $3 strike spread. So I bought it for, in this case, I bought it for $1.60. Max gain would be $1.40. So, over the next 30 to 45 days, VXX should be heading lower, which should move both my strikes in the money, and therefore my spread should increase in value, and therefore I would take profit. So again, this is the strategy, buying slightly out of the money, and you can see that the results have been pretty good. I'm going to be looking at trading this every 30 days. And again, if you want email alerts when I take those trades, check the description for that. And we'll see you at the next video.